Alright, okay, something new for today, bringing you massive value, as I would say. So what do I got to talk about today? It's going to be the Fed strikes again. Talking about how the Fed's just raised interest rates as part of a long-term plan of raising interest rates, what that means for you, what that means for the economy. Also going to be looking at back around 2007. The last time that the Fed had raised interest rates to the extent that they have done right now, what it resulted in. So, maybe that's a little bit of a preview of what's to come. What they say, something about history rhymes, but it doesn't repeat itself. Some people say history repeats itself. So yeah, make sure you stick around to the end of the video so you can just not understand what's going on right now, but you can understand what happened back then and put it all together. And yeah, if you like the topic, if you feel like you're getting some value off of what I have to tell you, make sure you go and subscribe, hit the thumbs up button, the like button, any comments or questions too, that's cool. Yeah, so the Fed just did its 10th interest rate increase this year of 0.25%, bringing the overall interest rate up to 5.25% from 5%. This is the highest the interest rate has been in America since about August of 2007. And yeah, this was no surprise, as the Fed has been saying for a while now that it's going to slowly increase interest rates over time, as that is its best tool to combat inflation. Basically, inflation is costs rising. By hiring interest rates, the Fed hopes that this will bring inflation down to their target of 2%, which is still a long ways to go. So looking at the economy right now, the biggest factors that come into play, I would have to say, would number one be the labor market, as far as, how many people are employed. Is there a high level of unemployment? And right now there is not. And this is something that a lot of people got wrong. A lot of people thought that by this far in the game of the Fed raising interest rates, that the labor market would already be falling apart and a lot of more people would lose jobs, but that has not happened. It might happen, it might not. Nobody actually knows. However, when you look at the overall economy and what has been affected by the interest rates, I would have to say that the bank failures of recent times is the biggest indicator that the raising interest rates have broken something, and that the banks are really, I think, the first major domino to fall, however you want to put it. But when you look into it, right, I mean, the banks fell because of the decisions that they made. Sure, the interest rate rose, but they were well aware of how the Fed works. They were well aware that interest rates could rise, and they were well aware of the investments they were making. See, in the past, the banks were always bailed out, and I think a lot of banks never really, got the message that they need to be responsible for what happens, because I think for the most part, people in society don't want their tax dollars going to bail out banks, when these banks are the ones that are supposed to be following guidelines so that they don't make these mistakes in the first place. And it's good to hear that, for the most part, these banks were not bailed out to the extent that they were. And yeah, the Fed is kind of saying before something about, they would keep raising rates until something broke. Well, something already broke and they're still raising these rates. Some people, spectators are talking about, the Fed's out of line, they shouldn't be raising rates so much. But at the end of the day, I mean, that's what they got to do. That's what they said they were going to do, and it's not like they went back on their word or anything like that. So, it shouldn't be a surprise to anybody. Like, everybody, for the most part, that understands the economy and how it works, understands that if inflation gets out of control, that what the Fed does is they raise interest rates. And I think that inflation has been out of control for a good time now, and it has not been coming down by itself. And that is pretty obvious to everybody. So, what does the Fed do? They raise interest rates. So yeah, looking at, the bigger picture of the economy, and the banks. Now I would look at the everyday people, consumers like me and you. And for us, what does this have to do with anything? Mostly it would be, taking out a loan, you're gonna have to pay a higher interest rate. Everyday things just like credit card interest rates. There's a really high level of debt right now in comparison to recent years, and that could play a huge impact, because if a lot of people have a lot of like high interest credit card debt right now and the interest rate keeps going up, I mean, a lot of these banks can go and raise rates. Not to mention, loans that banks might have made in the past, they might not be so quick to make right now with the current situation. Alright, so now looking at the past, going back to like 2007, looking at what the situation back then was, how the Fed responded, and how the economy responded after that. So, if it's anything like what's going to happen now, you can have a better idea of maybe how this is all going to play out. So yeah, this was right before the financial crisis, that the interest rates were at this point. The financial crisis itself, where prices dropped, hadn't actually happened yet, but it was just about to. And this was the Fed really trying to prevent it from happening. And it's hard to say, you can never know, but had you gone back and had they not raised the rates back then, would the crash have been much worse? I would say probably so. So yeah, in 2008, it was really the housing market crash. That was the main thing that really broke, with the interest rates being rose back in 2007. So by the time it was at this point where it was right now in 2007, it was still another year before the housing market kind of broke. Mostly because of the loans, a lot of, again, the banks, man. The banks really, they're supposed to follow a lot of regulations. I don't know to what extent they were following, and was it that the regulations were flawed? I think more it sounds like the banks were, just making some risky moves, hoping that they would get paid off from it. And yeah, what happened was, it crashed the housing market, and that's really, what resulted from the interest rates being rose, was that's what broke, and that's what caused a recession. And looking at a recession, some people say it's good, some people say it's bad. Depends on who you talk to. But definitely it was kind of like a reset. And really right about now, that really looks like what we need for the economy, is like a reset. Too much money was printed out, and then inflation went crazy. So yeah, I mean, people are talking, a lot of the media is saying like a recession is going to be a really bad thing, but in my opinion, I mean, if it's going to happen, might as well happen, get it over with, reset the economy. As far as like a entrepreneur business perspective, I would have to say it's a really good thing, because I always talk about how any kind of like economic mainstream media event that is really viewed as bad or negative, but most mainstream media is really like a lot of doors are going to open up to people that want to start a business, or people who have just started a business, or anybody really that's in business, if they understand the situation and the trends at the time. Okay, so really after everything broke back in 2008, that's when the Fed decided to go and reset the interest rate level back to almost zero. So yeah, they did that, and it stayed like that for many years afterwards. I would have to say, after the crash, from the housing market crash, it took a good maybe 3 years before the prices really started to rise again. And during this whole time, it was zero interest rates. So it goes to show, a lot of people that had money, they didn't have money to take advantage of the deals at the time. And a lot of people that had just started to come up at the time, they never really lost anything, because they weren't in business back when the crash happened. They were really in a position where they could, get a really good start, a really good head start, because they didn't have all this debt like a lot of companies that pre-existed at the time. Alright, so by about 2010, inflation had started to rise. A lot of people questioned the Fed as to whether they were going to rise interest rates, but they decided not to at the time, mainly because the economy was still recovering, and that was obviously the right move. So yeah, I think that was the right move, because it took another 5 years. It was about 2015 before the Fed started to raise interest rates again. So the economy was still recovering at the time, and I think if they had raised interest rates earlier, had they started that in 2010 instead of 2015, it would not have allowed enough time for the economy to recover. So this 7 years was basically like the recovery period. At the time, there was a really high unemployment rate. A lot of people didn't have jobs. A lot of people had especially been laid off or fired in the previous years. And this really was a big help to businesses. So what they were able to do was, with this low interest rate, almost zero interest rate, businesses were able to rebuild for the most part, which allowed them to bring back a lot more employees. This was the main factor, I think, back then the Fed was looking to fix. And it was slower than that for the housing market, but ultimately the housing market, started going back up around like 2013. Alright, so looking at a comparison of back then to right now, I think the main thing to consider is that it's a slightly different situation. Inflation is higher. The labor market is much different. But for the most part, the Fed is doing the same thing they were doing back then. So if you look at it like that, it would basically, if we followed that same time frame, would be that about a year from now, there would be a crash. Who knows where that crash would be, but some market would crash. One market would be like the biggest market to crash. So most likely, after the economy crashes, the Fed will bring down the interest rate back to zero again. And most likely that'll stay like that for a good 5 years, something like last time, 7 years even. So that being said, knowing that that's most likely the trajectory that's going to take place, it would make the most sense right now really to prepare for that low interest rate time to purchase assets that you would want to purchase. Most likely they would be at a better price, and it would be obviously a lower interest rate. When looking at business opportunities, maybe getting a business starting to get ready right now so that you can have it ready by the time everything changes, that would be a really good time to get one started. Yeah, so one last thing I want to talk about too is another benefit for just everyday people is going to be to hold on to money right now. I mean, looking at a lot of people that really have mastered the money game, like Warren Buffett, a lot of people are holding on to a lot of cash right now because they believe there's going to be a lot of really good deals in the future. So that being said, I mean, with the purpose of holding on to cash right now, these higher interest rates are good because you can make higher interest off the cash that you're holding. I mean, it was only like a year or two ago, you couldn't really get any interest rates at the banks. You couldn't even get 1%. Now it's pretty easy to find anywhere from 3 to 5% at a lot of banks for interest rate. I mean, there's treasury bills that are even 90-day treasury bills that are 4 point something percent. So yeah, there's a lot of good ways to just keep taking your cash and putting it through different interest rate time frames, whatever you can get that's going to give you the most return on your money, so that by the time that you want to use this money, you're going to have more of it. And not only will you have more than you have now, but you'll be able to buy more than you would have been able to buy right now. So yeah, that's about it. Looking at everything, breaking everything down, I mean, it's pretty obvious that this all happens in cycles. I think it's valuable for you to understand, how it happened last time, as most likely it's going to rhyme or be similar to that, and how you can benefit from it, especially, if you're trying to start a business, or you're just starting a business, or you've been running a business and you're just trying to make it better. There's a lot that you can do right now if you understand what's going on that you can benefit from. So, hope you got some value off the information I had to tell you. That's it for today. I'm out.